Let's concentrate on the longer term and on larger issues. Let's welcome our market master for the day, Sunil Singhania, the CIO Equity at Reliance Mutual Fund. He also joins us in his position as a member of the global board of the CFA Institute. He's the only Indian in that board, and its India chapter, CFA India, is organizing an India Investment Conference today, and Sunil is joining us from the sidelines of that India Investment Conference. Good morning, Sunil. Thank you very much to have us with you. I was asking your co-office bearer Jayesh a little while ago, what can you tell us about the India interest since the 2014 conference? Has the interest increased substantially, and are we able to maintain that interest in investment circles?
See, from an investment conference perspective, I think the number of registrations we have in this conference is the highest ever. So that clearly shows that interest in India is definitely high. We also have a good area of speakers, starting from Mr. Arvind Panagria and ending with Mr. Russell Napier. So I think that also shows that the conference and India has been able to invite the best of best as far as their interest in India is concerned. From an investor's perspective, we cover a broad array of issues in this conference. It is not a stock-specific conference, but a more global economy and Indian economy related conference. And I think very clearly the mood is very much positive compared to what it was last year. So last year we had some hope. This time I think the hope is really getting translated into a lot of optimism and a lot of enthusiasm for the economy as we move forward. So I think it's great times.
Okay. Sunil, hi, good morning and Happy New Year to you. I'll come to the economy in a bit and ask you what your view is. But before that, do you think the minor correction that started in the month of December has come to an end, or do you foresee more roadblocks?
See, Sonia, first of all, Happy New Year to you and everyone at CNBC. Corrections are a way of life as far as markets are concerned. Markets are never going to be linear. You can't have a market where every day the market moves up or every day it moves down. I think you'll always have this swings. Obviously, the world is one. A lot of factors are influencing volatility. Money supply in the world, interest in financial markets is very high. All the investors have the same information at the same time, and they want to act at the same time also, which causes more volatility in a short time. But very clearly from our perspective, our view is that any corrections, even in the future, are going to be swift and short, both in terms of the percentage corrections as well as the time correction. And I think our advice to investors has always been that use volatility as your friend and don't make it your enemy. So I think use this corrections to your advantage. Scenario going forward, even from a global economy perspective, is not worrying. From an India's perspective, as I mentioned earlier, there's a lot of enthusiasm, there's a lot of optimism, and as I said, use this volatility as your friend. So don't get hassled about it, whether this correction is over or not, whether this 100 points nifty up or down. I don't think it is going to matter in the broad scheme of things, unless you're a trader. So I think be positive, stay positive, and look at a little slightly longer term.
Okay, now that said, you have to look at the longer term. We have put in a 31% rally already in 2014, and there aren't that many green shoots of growth. Just yesterday, Sonia was reading out to us some research reports which were speaking about even Hero Honda and Bajaj seeing very, very tepid demand. Would you worry that valuations have run way too ahead, and maybe we will see some period of quiet in the markets or even continued selling, say in the first half of 2015?
So, Lata, it depends on your expectation as an investor. If you expect to make 100% in 1 year, obviously you're going to be disappointed. Having said that, if you go back and look at the period, when the first real growth in the economy, or the rapid growth in the economy happened, which was a period between 2003 to 2008, when the rally started in 2003, there were no green shoots also that time. But if you were late, even by 1 year, you would have had to buy stocks almost 100% higher. Because when the growth comes and when the numbers start to come, you're not going to be able to buy stocks at the levels which you were able to buy, say, last year, or even in some cases even now. So I agree with you. Stocks are not cheap. You have to be careful of what you're buying. But there is still a long way to go. That would be our perspective. And when the things improve, which they will definitely, because all the macroeconomic factors have started to improve, No one 6 months back would have thought that the WPI would fall to 0. No one would have thought that oil from $115 will fall to 50. So things, when they change rapidly, and there are always surprises both on the negatives as well as positives. And our view would be that the surprises on the positives are much more than they are going to be on the negatives. So as I said, if your expectation or if you aim to make 100% in 1 year, please don't invest in equity. But if you are satisfied with good mid-teen returns on a tax-free basis year after year, I think the next 4-5 years are going to be very, very good.
Okay. So let's talk about the positives and how one can play this in the market, Sunil. One of the big positives we heard from the coal secretary a couple of days ago was the possibility of higher coal production after almost a decade of subpar growth. And that will benefit a lot of power companies, infrastructure companies, etc. How do you play this theme in the market now?
See, one thing is we have to play the broad India growth story. If you see across ministries, most of the ministers have been very vocal about their plans. The roadmap has been set. Obviously, the country is suffering in the near term from lack of resources. But the fall in oil prices has been a sort of a godsend positive, and that would give the economy a lot of resources. Now, whether we increase coal production, obviously it is going to be positive. How we play it, we have to obviously back companies which are going to be positive, which would be the power companies specifically on this issue, or on the railway side, companies which are engaged on the railway side. But one note of caution, play companies which have balance sheets which are repairable. There is a section of companies where the balance sheets are irreparable, and there is a section of companies where the balance sheets are repairable. I think the benefits are going to be more pronounced from an equity investor perspective in companies where the balance sheets are repairable. So while focusing on the big picture, which would be power, infrastructure, defense, railways, I think you also have to be very clear in the stocks which you pick. And it is very visible, if you see within the sectors, there, even, if say auto is done well, there are companies which have done phenomenally well, and there are companies which have not performed at all. And same thing is the case across sectors. So I think stock selection, even within sectors where you're positive, will become very, very important. So our call would be that stick to quality, stick to balance sheets where it is repairable.
Okay. Well, obviously, finance is a big sector for all funds. And last year, the bank index, the bank Nifty, turned in a very smart performance of almost 60%, if I'm not mistaken. But even better was the performance of the PSU banks. Where would you put your money in 2015, or at least put your bets? Is the finance sector itself likely to turn in a decent performance? Which subsector within the finance space?
First of all, I like to correct, the private sector banks have done better than public sector banks even in 2014. The second thing is, obviously there is positiveness in both the category of banks. Our call from a longer term perspective would still be the private sector banks, because inherently, they are gaining market share. The problems in terms of, the duration of the top leadership is not there. The problems in terms of asset quality is not there. There is some green shoot as far as the public sector banks is concerned. This Gyan Sangam and complete autonomy to the public sector companies, at least the announcement is very positive. The fall in the government yields is again going to be near-term positive. But there are some structural issues. So unless those structural issues are resolved as far as the public sector banks is concerned, our longer-term bet would still be on the private sector side. The public sector banks would be tactical plays, based on valuation and the near-term upticks which can happen. But till we see, the longer-term issues resolved, we would stick with the private sector banks.
Okay, stick to the private sector banks. Just talking about the macros a tad bit more, Sunil, this will be the first full budget from the new government, so all eyes will be on that. What are the realistic expectations from the market?
See, budget always has a lot of expectations. As you said, this is the first full budget. Both the finance minister as well as on the railway side, the railway minister have been very vocal in trying to say that they want to, build India from a 5-10 years perspective. So I think from a market perspective, the roadmap, more from a longer term perspective, is something which would be watched very eagerly. So whether, the roadmap of fiscal deficit going down to 2.5-3% over a period of time is there or not, whether the imbalance in planned spending and non-planned spending is managed or not. I think it would be more to do with the longer-term strategic goal plan as far as the country is concerned, rather than watching 5% excise duty cut or increase here and there. So it's going to be more like a company making a 5-year vision rather than focusing on this quarterly numbers. And I think the same thing would be expected even from the budget. So it's going to be more, at least from our perspective, we'll be more happy to have a 5-year vision rather than trying to say that next year the fiscal deficit is going to be 3.8% or 4%.
So, no, just as a follow-up to that, if we, there are many expectations that the market has generally in terms of clarity on retrospective taxation, on GAR, on FDI in various sectors, etc. Suppose we don't get 1, 2 or 3 of these things, do you think the market will be disappointed? Or given that there's so many reforms that the government is already undertaking outside the budget, it will just move on?
Frankly, I don't have an answer to that, Sonia, but I would like to put it in another way,
Sure.
August 2013, the market fell because there was this concern about QE tapering happening. And as we speak, there is no QE left, and still the US markets are at an all-time high, the bond yield is at an all-time low, and the emerging markets are thriving. So it is very difficult to say that if this thing happens, the market will be positive or negative. I think the market looks at a holistic picture. The finance minister and the government realizes that whatever they need to do has to be done in a manner which is not counterproductive. It's not negative from an investor perspective. We in India continue to be a deficit country as far as capital is concerned, both on the equity as well as on the fixed income side. And our view would be that the government cannot afford to do anything which would be negative from a foreign investor's perspective. So I don't have an answer to that, but our view would be that, don't look at one point and try and paint a negative picture on it. We have tried doing it for so many years, and time and again we have been proving wrong, thankfully, from an equity investor's perspective. So we are optimistic, and let us see, we'll take things as it comes.
All right. Give us some flavor of the broader markets or the mid-cap space, Sunil, as you see it from your vantage point. Will mid-caps as a class outperform? And within that, we have had every now and then some interesting themes, logistics, home improvement themes, paints, crude derivative companies, chemicals. If you have to pick up 1 or 2 interesting sectors that will be at least on your radar in 2015, what would they be?
One is we should not look at mid-caps as a category. Okay. I think there is a whole mixture of stocks in that mid-cap basket, and some are exorbitantly expensive. A lot of them still have value, but you have to be very clear of what you're playing for. We get scared with relative valuation. If one company is trading at 50p, someone goes and buys other at 40p, I think that is disastrous. So look at every company in isolation and with individual merits. As far as themes are concerned, we did play the home building theme quite well. Our theme going forward is going to be more on the urban consumption story. Last 4-5 years, the rural income was going up, urban incomes were not going up, and inflation was hitting the urban savings a lot. I think that, according to us, will change. Inflation is down. The job scenario is increasing, specifically on the back of the focus on manufacturing, which we expect will take off in a big way. And that should mean that savings and spending on the urban side should outpace the rural side. So urban consumption, which would include housing, home building, a lot of FMCG consumptions, I think that can be a good theme. And the other thing, obviously, it would be sort of a mini theme, but operating leverage. So there are a lot of companies which have capacities which are not being used. I think as the capacity utilization improves, a lot of these companies will suddenly report numbers which would surprise the street. And preeminent in that would be the cement side, where the capacity utilization are low. We are already seeing some of that in the commercial vehicle side. I think that should also improve. Even on the engineering and auto ancillary space, there's a huge capacity which has been built up, not being utilized. So you'll start to see some operating leverage kicking in there also. So I think operating leverage play should be a good theme as we move forward.
All right. Sunil Singhania, you've given us a lot of time today. Thank you very much for joining us on what's a very busy day. Hope you have a very good conference, and thank you for enlightening us on such a large range of macros and micros.